Joining us today, Charles Schwab, Chief Investment Strategist. Ann Sonders is with us. Ann, great to see you.
You too. Nice to see you guys.
B of A, the desk today says, is this the great breadthening? And they argue yes. Do you agree?
I think it's a little bit too soon to judge. I think we're going to continue to be at the mercy of the economic data, as Sarah pointed out. I think the initial move to a broader market behavior and the lift in small caps was the better than expected jobs number. And you're seeing the same thing in terms of expectations around both the June and the July Fed meeting. And with regard to that, you then get the worse than expected claims number this morning, and you see expectations shoot up in terms of the likelihood of a pause, or what I guess we're now calling a skip. So I think we'll continue to probably see some jumping around within the market in terms of leadership, very much driven by the short-term trend that we're seeing in economic data.
Right. Meanwhile, we're paying attention to some of the bull-bear surveys today and the underperformance of a lot of funds that didn't double down on tech at the beginning of the year. I wonder, what do you think the chances are of a chase, so to speak, in the second half?
So I think probably the pain trade is still higher. And, inevitably you're going to get FOMO type behavior, especially when it's in a lot of kind of household large, and it's not all tech, of course. I generally refer to as sort of techie type names because among the, as you said, Magnificent Seven, Super 8, whatever subset you want to talk about, it does span in tech, communication services, consumer discretionary. If you look at the top 10 stocks, you even move into healthcare and energy. So it's more than just tech, but it's enticing for a lot of investors. I think the caution, of course, is you get reversion to the mean periods, whether it's a couple of days or something longer than that. You have to be really careful about not letting your portfolio get similarly concentrated as what we've seen in terms of performance this year, because the inevitable other side of that can be painful.
On the Fed, which dominates the market conversation, Ann, so the expectation now in the market is a skip, as you say, pause in June, hike in July. Then what? What's the expectation from the market if we get a hawkish message next week? Is that already priced in? You think the market's going to be okay with that, or is there downside risk?
The market has mostly priced out rate cuts, although it still looks like there's about one cut by year end priced in. I think that continues to have to get priced out. In fact, what's interesting is many times when I hear the really bullish thesis for the market, it's been predicated on what had been an expectation of rate cuts in the second half of the year. And always in my head was, boy, be careful what you wish for, because the conditions that would give the green light to the Fed to not just pause, but to actually do a 180 and start cutting rates after the most aggressive hiking cycle would be relatively calamitous in terms of the backdrop. So I think the market is coming to grips with what the Fed has been trying to, shove in everybody's faces, which is once we get to the terminal rate, we're going to stay there for a while. I think there's probably still a little bit more that has to come out from a market perspective in terms of the timing associated with that pivot. I think this is more of a higher for longer kind of environment, certainly what the Fed has been telling us.